All right, welcome and good evening, traders. It is Thursday, March 14, 2024. Down day in the market. Good day for our portfolio today, as we ended up with a decent day today. Let's jump in and let's take a look at the portfolio first, and then we'll take a look at some of the markets and charts and see where things are for today. So let me go ahead and share with you, and let me get me off the screen so that you can see everything. Perfect. There we go. All right. Here we go for today. We ended the day at a minus 51 delta. So delta minus 5.1, very delta neutral, perfectly just slightly negative, which is the way we like it, to pretty much just flat. So delta neutral, very well balanced portfolio. Theta 1175 on the day. So a little bit of an increase in the theta as well, taking us up to 0.27%. We did see a little uptick in the VIX, almost 5% in the VIX. Moving up today, so that's a pretty nice helping hand for us to increase some volatility, gives us a little bit more extra theta. All right, so on the Netflix side, 437.72, slight increase from yesterday when we recorded the figures after hours there. So 437.782, not too shabby. We'll take that. Pretty much in line with where we've been the entire month, really. So since the first of the month, we've not been up or down more than couple thousand bucks or so. Just really not going anywhere. You got some things going up, you got a couple things going down. So for us, just moving forward, BP 266.093, which puts us, after we subtract our bill percentages out, puts us at roughly 51%. So we are perfectly where our buying power should be on the session. Didn't place any trades today. Had a lot of errands, things to run on my own. So the nice thing for us is, hey, you don't have to trade if you don't want to. In fact, you can see here, we haven't closed a whole lot of anything. We haven't really added a whole lot of anything. When you're sitting right here at this 50% line, you're just letting theta cook for you. And that's really our goal here, is utilizing our buying power sizing. Okay, is perfect for us, and then we're letting this theta cook. For the most part, you got a couple ups and downs, and we're still stinging a little bit from the HG strangle loss, but we had another, or from gold strangle loss, I should say. But we have an HG strangle winner for the month, so that's really evened things out a bit for us. And then we just had to put debit spreads that have been coming off. We will have some hedges coming off soon. So in the next couple of days, we'll start to see some hedges coming off. So it'll be a little bit of a realized loss. It's not really affecting anything in here, but we'll start to see some hedges that we've had on coming off. Spec trades, good spec trades for the month so far, up $2,000 there, and 0DTE adding another 900, almost $1,000 to the account. So overall, pretty good. We're still sitting really around 11% up year to date. Not sure why we have an issue here on Google Finance, but we'll take a look and see what's happening for that. In fact, we can actually do a quick look ourselves by stock. We'll see what's wrong with our formula in a little bit. But if we take a look at SPY and we look year to date, SPY is up 8.95% on the year. So 8.95, we're sitting up over 10%. So still out dueling SPY, but we really haven't done a whole lot this month yet. So we'll see what happens. We need a couple things to kind of calm their way down a bit, and mostly the copper strangles and a few other things, but that's pretty much it. It's copper, and then everything else is in really, really, really good shape. All right, so there's where we are. Can we put new trades on right now? No. Buying power says nope, no new trades. Okay, just continue to let your theta work. And once we start to close some off, you're going to start to see this realized gains heading up. And we do have stuff that's getting close. We're just not there yet. So on ES, we've got some long puts coming off tomorrow. That's all good. Or at least one long put coming off tomorrow that was part of an old long-term 112. We've got hedges that are about 2 weeks out before they start to come off. We'll see how that works. We've still got decent 112 trades on. Both of our 112s for April have not yet They just hit 90 days, which is about when the naked puts come off. But due to the recent pullbacks and a little bit of volatility pop here, you got IV up to 18, which is a pretty good move up in IV on ES. So overall, a little bit of an increase in volatility. We're heading into the Fed next week on Wednesday. I really don't expect a whole lot of anything to happen there. Don't expect them to move rates up or down. And I don't really expect them to say a whole lot that we don't already know, but we'll see. But I'm sure that's going to contribute to a little bit of volatility going on in the market. I think the other thing to potentially take a look at here as you work through some of these trades is when will these naked puts come off? We got one at 91% for April 19th, and then we have another one that's at 86%. Still has 20 days to go before it hits the 90 days, so it could still come off. So overall, we are doing just fine, but we should start to see some realized gains, and those gains are going to be to the tune of almost $3,000 and $4,000 respectively. So I would expect realized gains of almost $9,000 just from long-term 112s alone this month. So we'll see some of that stuff come off, and that's really going to help our buying power as well. We'll have some time to put some new trades on. All right, so there's where we are. There's our diversification a bit for you. And then lastly, the strategy builder thing, we've had this on for a long time. And we refer to it mostly in our trade group, but just to give you a sense of how I'm trading, this is how this account is currently allocated. Again, we're sitting at a $440,000 account. We've moved our allocation on long-term 112s down to 50%. Why did we do that? Well, the reason for that is because if we go any higher, right now, 6 contracts a month is what we're anticipating. Okay, we're allocating about $110,000 in buying power. Okay, this is the buying power per trade, the profit per trade or per contract. They take about 90 days. So we can get 6 of these on. The key here was when I had this up around 60, 70%, now we're talking 7 or potentially 8 contracts. Well, the problem with 8 contracts is the trap on those, having 8 contracts would mean 16 naked puts. Well, that would a 2x loss on those would put us over a 2% max allowable loss in this account. So we have had to, because of the account growing, we have had to shave down our long-term 112 trades. And really, the maximum right now on our buying power is only 6 contracts a month, which is technically 6, 6, 12, or 2, 3, 3, 6s is what we're doing. So there's where we have to stay. Otherwise, whether we close at a 1x loss in the trap or 2x loss on the naked puts, either one's acceptable. Here, those would start to exceed our 2% max loss for the portfolio. And I don't think other people are sizing this way. I'm watching people putting on daily 112 trades or 111 trades or sizing up as their portfolio grows. And it's all good because, yeah, you have the BP to do so. But the question is, what does your max loss look like if you would get stopped out? And now getting stopped out is a significant, 15 to 20% down move, probably closer to 12 to 15% with a volatility spike would stop you out. It doesn't mean that could happen tomorrow, but if it does, you would have to stop out pretty early, or if you held it to a 2x loss, you're going to exceed your max loss. So something to consider there. So I'm having to really curb the size of the long-term 112s. 30% of my portfolio is in 112 futures. I'm allocating about $65,000 to those types of trades on futures 112s. I think I'm probably pretty close to that right now. That should generate another $4,000 in income. Strangles on futures, I'm allocating $32,000. In fact, I just put another strangle on here. So really, when I look at how much, I've got $45,000 invested, but I'm under my 50% buying power. So I thought I could add some more. And if I'm going to add, and my long-term 112s are full, if I look at my 112s on futures, there's quite a few of these up in here. You're talking, 20, 30, 40, 50, 60, 70, 80, 90, almost $100,000 worth of buying power is allocated there. So I'm over allocated, which is fine. You can be over allocated on these things as long as you're not exceeding 50% of your buying power. Because of the way span margin works and because of the way that I trade and diversify my portfolio and the hedges that I have working, it gives us a little bit more flexibility in our buying power. And one of the things we'll take a quick look at as well is we'll take one more quick look at our allocation before we jump today and see how we're allocated across different underlyings. Okay, so we've got different strategies and different underlyings. Now, my future strangles, like I said, 15%, 32,000. I did add another strangle today. SPY lead puts, we don't do that in this account. In fact, I probably should just remove this from this particular trading platform. But one thing we are starting to do, and I am going to allocate some money to this. And one of the trades that we're doing now, in fact, let's add this to. I don't normally do this on the YouTube channel. I usually save this for members. I'm going to give you guys a little bit of an insight of how we manage things as well. But we have come up with a new trade. It's a 120 DTE naked put. Okay, so I won't give you all of the specifics on this naked put on how we manage it, but I'll even give you the fact that it's 6 delta. Okay, so I will give you that information right now so you can see what that looks like. I'm going to be putting these trades on here. Give me 1 second to take a quick look at what this trade is. You know what? My buying power is so strange. It's hard to even get a sense of what my true buying power is. I can't even get a read on that right now. Let me see if I can. I don't even know that I've recorded this trade anywhere. Oh, I have recorded this trade. Okay. Yeah, I don't even know what my margin on this trade would be right now. So if I really went and run out there to roughly 120 days, and I look at roughly a 6 delta put, yeah, I'm getting a credit for putting this on. So I can't even figure out my buying power on this particular trade. So we'll have to sort it out a little bit as we go forward. But I'm going to start to allocate some money here, maybe even taking it out of spec trades a bit. But we're going to start to put this particular trade on here. And the average profit on this trade for us right now, I think I undersized it a tad when I put this on. I know maybe you're thinking, what the heck is he even talking about right now? Here, I'm looking at my portfolio. All right, and if I start to put this trade on, it's going to generate about $3,000 in extrinsic value. All right, so when I take this off, I'm going to guess we're going to make about $900 in profit on this trade, and I'm going to expect to be in it for about 30 days the way I have set this particular trade up. What if we put 2% here? Okay, I'm going to ignore return a month or so on these. In fact, let's go to 5%. I think this is perfect. All right, so that's what we're going to do, and I'm going to remove some of that money from spec trade. So we've got 50,000 plus 30 is 80 plus 585, and then we've got to take a little bit out of one of these particular things. Maybe we'll take some out of the 112s on futures right now. I like this trade. I'm not saying that these numbers are all correct here. I believe the $900 a month will be about right. But this is what we're going to start to configure for ourselves, but this is how we strategize with our portfolio. So this is now going to become a new campaign style trade. This is something we're going to be doing moving forward. I'm not going to cover exactly how this trade is engineered, but and how we tested it and when we enter and when we exit. It is a pretty cool trade, and in the back test, it performed phenomenally through COVID, through down markets, bear markets in 22. It performs unbelievably well the way we have this thing configured. So I'm pretty excited about launching this trade. We're doing it in every account, small accounts, big accounts, all of our accounts, and I'm willing to peel off some of this. I'm not saying it's going to generate 23% a month here. That might be a little excessive on it. But I think that's just the way that this is currently setting up. We really don't know what this BP amount is going to entail. So we'll get a good sense of that. Maybe it's going to be 5,000 in BP. Who knows what this thing will actually take, because of the way we're set up. Anyway, and then we've got spec trades in our bill ETF, and I think we need to add in our bill income for the month, which we have not really done our bill income for the month. In fact, let's see if we can pull that up while we're talking here tonight. So I'll keep going here, but if I can add my bill, let's see if we can jump into our Tastyworks account. We're going to jump in really quickly. Tastyworks. We're going to look at my account here. I'm going to jump in. Great. Tasty is a new management page. We'll deal with that later. I just want to see my transactions for the month so far. So I know this is boring radio or TV or whatever you're doing, watching me here. But let's take a look at our bill, and there she is on the 675. So let's add that in, 675. All right, so there's our bill distribution for the month. 675 is what we're making with all the bill that we have going on. So so far, now obviously in January you don't get any because they do a double distribution in December. Yeah, we've pulled in $1,400 in bill, and we're sitting using 43,000 in margin. So 1,400 using 43,000 in margin is 3%. Okay, in technically 2 months, 3 months, whatever you want, however you want it, literally 2 months. Okay, so we've made 3% in 2 months. Okay, right now with our bill, we are on track, okay, to earn, 3% in 2 months. That's 1.5% a month. That's about 18% a year. So that's what we're shooting for on our bill. So we're going to make some nice cash there as well. So I wanted to add our bill in. So anyway, this is how we build our strategies. This is how we test them out. This is how we figure out what our allocations are going to be. Now, typically in a perfect world, your monthly P&L is going to exceed what we're shooting for. We're shooting for 13,000, which is 3%. This, if we would hit it, would be 18,000, which is what we've been doing, each month. 21, 22. This month we're not quite there yet, but we have some time to get that going. But if in a perfect world, this is what we would be looking at from each of these particular trades. Okay, if everything goes perfectly according to plan, which again, nothing ever goes perfectly according to plan. And because we took a loss on a strangle, that's going to probably impact this overall month. Maybe we'll make 13 or 14 instead. Okay, still beating 2%, and 3% is our goal. So that's what we shoot for, and that's what we're going to try to hit every single month. All right, so that gives you a little bit of an insight as to what we're doing. Now, how did I diversify myself here as well? If we take a look at our overall portfolio, so here's the portfolio that we're doing, and you can see 28% of the buying power we're using is allocated to ES. That's it. We are only using 28% of our total buying power for ES futures. That's it. 19% of our buying power, almost 20%, 19% is in bonds. Okay, so bonds is our number 2 holding. Number 3 holding is oil. 17% of our buying power is in oil. Okay, the next largest from there is technically RTY. So right now it is in the Russell at 6%, copper at 5%, NASDAQ at 4%, the Aussie dollar 3%, a little bit of gold down here, gold way under right now because of the big spike in gold. I wanted to let it settle down before we jump back in. And then our bill, our Treasury T-bill ETF is at 16%. So when you look at this and you start to think, oh, I'm worried about a market crash or the black swan or the, I don't know, the red swan or the 50-day death march or whatever it might be here. Okay. If the market drops, what's going to drop? Well, ES is going to be hit. So that's where I'm hedging. Okay. If the market drops, will people fly into bonds as a safety measure? And the answer to me is probably yes. Okay. A flight to safety to me would be a flight to bonds and a flight to gold, which were underweighted in gold. So I want to get back to adding more gold. If the market drops, bonds and gold. If the market drops, what happens to oil? I don't know how closely oil is correlated. I don't believe some of the things I've seen on it, but I think, well, let's say it's 50% correlated to the market. I mean, if the market drops significantly and people stop spending, then oil is going to, prices may come down, and that might hurt oil as a whole, but not incredibly a lot. But we're going to be diversified into oil. Obviously, if the market S&P drops, you would expect that the Russell will probably drop. But if this, again, if the market crashes, which is not my intent here, most likely I want a pullback of 5 to 6, 7, 8, 10%. If that happens, I think small caps are going to take off. I think there's going to be a rotation into potentially some safety, bonds and gold, maybe into some oil. But I think also small caps are going to benefit. So I'm starting to load up on small caps a little bit more. So as I take off some trades that I have in ES, not the long-term 112s, okay, that's a beautiful trade. I don't do anything with that right now. Let the campaign run. But I do have a lot of other spec trade type trades and 112 trades and some strangles at times in ES. I'm going to start to shift some of that 112 trading off to RTY because I think this is the next opportunity this year. I think if you get some pullback in the Magnificent Seven, today you saw NVIDIA down 3%, Meta down 1%. Those are the 2 weak ones right now. Okay, that's where I would be looking for weakness. If those 2 keep moving up, the market moves up. If Meta and NVIDIA can't, plug a little bit of a pullback here, I mean, Apple's already down, so it might be okay. Microsoft has not dipped at all, so that might start to head lower. And then Amazon and Google, they're both looking decent as charts here. So Amazon could be ready to keep moving its way higher. But anyway, I want to show you this because this really is, to me, the core principle of diversification. Okay, number 1, I'm diversified by strategies. Okay, ES 112s, 50%. 112s on futures, 25%. Future strangles, 15%. Naked puts, 5%, and some other spec trades, 5%. Okay, so I'm diversified by strategy. Inside of those strategies, I'm diversified by days to expiration. And then I'm also inside those strategies diversifying by underlying. Okay. That is the name of the game. That's what's going to keep you in the game longer and safer. Okay. I'm not saying don't hedge. I'm hedged. Everybody should have hedges on. Okay. You got to hedge. Okay. There's just some hedges I like more than others. Okay. So I certainly think you should hedge. And because of the way I manage and the way I hedge, okay, And the way I diversify, okay, it's opening up buying power for me to be much more effective and efficient and get some more trades on than my strategy builder tells me that I should have on it, at least at a minimum. So as I take trades off and I put hedges on, and I reduce my buying power with hedges or by adjusting trades or by staying delta neutral and by staying a little bit, diversification neutral, if you would have it, where I'm not heavily weighted in anything. 28% is in the S&P 500 futures. That's it. Okay. I'm not at 70, 80%. So do I need to hedge the same way as someone who is massively in ES 112s? No. One hedge doesn't fit all. You have to figure out what is right for your portfolio, what makes sense, and what are you hedging? What things do I need to hedge? Do I need to hedge oil? Do I need to hedge gold? Do I need to hedge copper? Well, because they're such smaller percentages on most of these, I don't need to hedge the same as everyone else needs to hedge, okay? Because they're more heavily weighted in the S&P, which means if the S&P gets crushed tomorrow, I'm not saying we're not going to feel some pain here, okay? But I feel that the hedges I have on are going to more than take care of me and limit the damage. And the goal for me on a hedge is to limit the damage and give me buying power relief. That's it. And I like, the one thing I don't like, I don't love super far out of the money long puts, because you really have to go down hard and see a massive volatility spike for that thing to even get out of bed and wake up and do anything. However, what I like more, and we did this the other day in our small trading group sessions that we have here with our members, one of the things that we experimented with on the risk analysis graph was, what is the difference between a high delta long put, maybe 1 or 2 contracts, versus a little bit lower at 4 contracts, a little bit lower delta, or even a little bit lower delta than that with 8 contracts. I'm not saying going down to 1 or 2 delta or something silly. Okay. What I'm saying is you get better hedging and buying power relief to go down a little bit more, spend the same amount of money, and add more of those long hedges. And I think that's really the goal of some of the people doing the Black Swan hedge as well. They're trying to build this wall of really far out of the money puts. Okay, that's going to help them in the case of a Black Swan event. Totally fine. It's a similar concept, just a different way of doing it. Either way, you have to pay for the hedge. Okay? Black Swan is not free, because in order to do that, you had to put on a trade, take the profit from the trade, and then buy the hedge. You still had to buy the hedge. Okay. Whether you put on a trade in 3 short naked puts to buy 5 longs, okay, or you put on an extra 112 trade somewhere, make $900, and then use that 900 to buy a hedge, either way, you're buying the hedge. Okay. It's not free. Okay. It's essentially what you're trying to do, though, is create a good handful of, hopefully not deep out of the money, but out of the money puts that's going to help hedge your portfolio. So I hope this makes sense for you. We didn't really get into the markets tonight. We can do that in another video. I wanted to make sure that you understand that portfolio strategy diversification is important. I want you to diversify by strategy. I want you to diversify by days to expiration within that strategy. And I also want you to diversify by asset class or underlying. Okay? If you do those 3 things, okay, and you have a little bit of hedging on to begin with, and hedging what needs to be hedged, like ES, I'm not hedging oil or gold or copper or those things right now, okay, because they're so small. Okay, I'm hedging ES, and I'm hoping, it's not a trading strategy, but I'm planning for the fact that if the market does go down heavily on ES, there's going to be a flight to safety or a flight to quality, which would be bonds and would be gold. And I really love bonds. It's my favorite thing right now. Oil was my favorite. It was one of my largest. Bonds are now number 2 in the portfolio. So bonds are number 2. I just put a new bonds trade on today. It took me 2 days, but I'm patient. I'm not going to chase the prices. Okay, I rejiggered the trade as it moved down. I reconfigured everything today, got into a better trade at a better premium today. So again, pays to be patient and not chase trades. One of my trade rules is don't chase the trade. There'll always be another run around the corner. Paid off super for me. I made a lot more money selling premium in the new trade than I would have made in the original trade. And I was able to take advantage of a little bit of the market move today as well. In fact, I'm looking at it right now. That trade is actually up 10% today. Okay? So I'm already up 10% in one day because I was patient yesterday, not chasing the trade and trying to make something fit. I waited till today, so I had a better price and a better buying opportunity. Anyway, that's my thing. Diversify, strategy, DTE, asset class underlying. Have your hedges on of what needs to be hedged. Okay, be smart about it. And when you do that, hopefully it all comes together for you and really gives you a leg up on the market. All right, take care. Have a great evening. I hope this was helpful to you. If you like it, hit the like button, please. Give me some help here so we can get the word out to more people on YouTube. And if you're not a subscriber, I don't know what you're waiting for. Okay, become a subscriber. We'll see you guys later. Take care. Bye-bye.